Okay, brilliant. I think it's probably about time to get started. So hello and welcome along to everybody joining for today's session. My name is Ciaran McDiamond. I'm the head of global marketing strategy at the De Vere Group. And today we're going to be hosting a session where we're going to be looking at some key things that British expats in the Middle East and the wider Gulf region should be thinking about in terms of maximizing the wealth potential whilst they are resident here. Now, today I'm joined by a panel of industry experts who are going to be sharing some of their expert tips that everyone in the region should be all too aware of. So firstly, I'm going to just pass over to Darren Jones to give himself a brief introduction, then we'll pass along the panel and then get stuck into the session.
Great, thanks, Ciaran. Yeah, so my name's Darren Jones, so I am head of global technical development here at the De Vere Group. So my career now stretches back some, 30 years, I would guess, just over, in fact. So I had 15 years working with a business most of you will know, known as Royal Insurance, now Royal Alliance. Had another 14 years with a business known as Old Mutual, now Utmost International. And I joined De Vere 6.5 years ago working here in the Middle East. So my specialism is in relation to taxation planning, trust planning, repatriation, particularly for British expats and those with a UK connection either now or at some point in the future. So that's me, Ciaran. Thanks for the invite along today.
You're most welcome. Rebecca Ellis, over to you.
Thanks, Ciaran. So as I'm Rebecca Ellis and I work in our technical team at De Vere. So I work alongside Darren, do a lot of similar kind of areas of expertise, such as the retirement planning, tax planning, trust planning. Also get involved with lots of the in-house training. So not just for our staff in the Middle East, but across our other offices in Europe and as far as Australia and New Zealand. In terms of my background, so I've been with the company for about 5 years now. And prior to that, I was in the UK, and that's where I did all my qualifications. A chartered financial planner, which is the highest level of qualification that you can get in the UK. So it was when I graduated that I spent a couple of years getting through all of my exams, became qualified in the UK, spent a couple of years in a technical role there, and then have now moved and living in Dubai.
Okay, brilliant. Thanks, Rebecca. And over to you, Alex.
Yeah, thank you, Ciaran. So my name's Alex Olleveant. I'm a UK qualified financial advisor. I've been with De Vere for the last 5 years, work with a number of clients across the Middle East, most of them here in the UAE, and I also manage a number of clients further afield as well. I'm often leaning on Darren and Rebecca for assistance with my clients that, as Darren said, have a UK connection, are going to be returning back, and for some other requirements for some specialist cases as well.
Alex, I just want to address, firstly, why is there a trend in the Middle East of expats coming here and leaving in a worse financial position than when they actually arrived?
Yeah, so for me, I think this is not funny, but it comes down to a really, really basic requirement, which is budgeting. Right, so when we're in the UK, we're so used to paying things like national insurance contributions, the welfare benefits, and of course income tax is PAYE, so the tax is deducted before you get your income. Now, when you come to the UAE specifically or other countries across the Middle East, you actually don't pay any income tax, so your expenditure basically doubles right away. Now, with that, comes more expenditure here as well. So rent is more expensive here. Childcare is more expensive here. Schooling fees, food. So everything doubles when you move over here, but the saving level doesn't. Mm-hmm. People are either saving the same amount, less, or not at all. And that's the trend. People don't know how to budget. They enjoy themselves a little bit too much. This stuff can be avoided. So I sat down with a client a couple of weeks ago. Earns 40,000 dirhams a month, has been here for the last 5 years, but actually only has 100,000 dirhams cash in the bank. That is only 2.5 months' salary in a region that's very transient. Job security is not the strongest here.
Sure.
And when you break that down across the last 60 months that they've been here, that's less than 5% a month that they've saved from their monthly income. Yeah, so it's a budgeting issue.
Absolutely. Yeah. Okay, so when you're first sitting down with clients, you've got a lot of first-hand experience being in the job now for 5 years. What are some of the first things that you look at to just get the ball rolling? Because obviously there needs to be a focus on getting expats to the point at which they leave in a financial position that's far better than when they arrived. Of course, you know, most of us, if not all, came here with the intention to really build a financial foundation. So what are the first exercises that you do when you sit down with clients just to get that ball rolling?
Yeah, I mean, so first of all, every client is different. Everything that I do is a client-driven process, right? So when I sit down with a client, I have to go into that meeting with a clear mind, right? And what I'm going to do with the client is I'm going to carry out what I call a liability assessment. Okay, so that's actually got quite a negative connotation to it, but you have to understand the liabilities or the negatives to be able to start making improvements.
Sure.
Okay, so this liability assessment will cover different topics. Okay, so it starts off with some basic stuff, personal details, children. Then we look at what your income is, what your expenditure is. Okay, then we, if we're looking at retirement specifically, and some clients come to me with stuff already in mind, but UK expats, we need to look at what your entitlements are in the UK, right? The UK state pension is the most basic entitlement that you can give yourself when you come overseas. And continue to give yourself. And then we need to look at what you already have in place. Okay, so any existing workplace pensions that you may have had, private pensions, ISAs, we need to assess what it is that you've already got. Okay, and then we need to work out where it is you want to be later on down the line. Okay, once we've assessed that, okay, we can then find out what you need to do to bridge that gap.
Sure.
Right, so I call it the power of three, right? Step 1, state pension. Step 2, existing assets. Step 3, bridging the gap.
Okay, so that's the process, and if not all people should be doing that once they arrive here as early as possible, right?
Yeah, and don't get me wrong. When I sit down with a client, like I said, they may already come to me with one thing that they want to discuss. But once we've carried out a liability assessment, quite often there's 3 or 4 things that they need to start assessing.
Sure.
Clients can't do all 4 at once, no, but it's important that they at least start on that journey.
At least getting it in their mind.
At least getting it in the mind.
Yeah.
Exactly right. Yeah.
Okay, brilliant. Thanks for that, Alex. Darren, we're going to move over to you, someone with extensive experience in the UK. Now, IFAs, as we are, financial advisors, typically use tax-efficient solutions in the UK. ISAs are probably the most common form of tax relief given there. But given that we don't have these solutions in the Middle East, what should people be thinking about in terms of their planning?
Okay, so it's not perhaps that we don't have the solutions. We don't need the solutions while people are living and working here because we're in this wonderful tax-free environment. So we use different types of savings products and investment products that we've got an eye on future residency rather than where we live today. So it's more about your future residential intentions than perhaps your current residential status. So important that we use a vehicle to satisfy needs, and it might be a savings vehicle on a monthly or quarterly or ad hoc basis. It might be a lump sum investment plan. It could be something that you place your UK pension in. There are various different types of structure that we're using. But the important thing is we need to know ideally where you are likely to retire. Where will you be in 5 years, 10 years, 2 decades time? And then we can plan from a tax efficiency point of view for that. Now, I think a lot of people logging in today, watching and listening today, will be British expats, or at least there will be people who will end up living in the UK at some point in the future. And the type of structure that we tend to use for that is something that is well regulated and very tax efficient and probably in a jurisdiction close to home. So I'm thinking Isle of Man, Channel Islands, Dublin. Sometimes we use even Mauritius, Luxembourg, places like that. So tax efficient, well regulated, and a jurisdiction the clients are comfortable to use. Why do we use those jurisdictions? Well, because when you then live back in, for example, the UK, you can continue to grow that money in a very tax-efficient environment. You can grow it, you can change the investment, you can realize capital gains, generate income without any need to pay tax to your local tax authority. Works exceptionally well in the UK, works exceptionally well in a lot of countries around the world as well as the UK. So it's not just for the British expats and people living there in the future that we're talking here. But it might just tweak slightly depending on where they will end up going to. Australia, for example, South Africa, Spain. There's various different derivations of the same type of product that we tend to use. So we have what I refer to as our flagship product. That's the product that I'd like our British expat clients to aspire to. It's one that I personally invest into. Mine happens to be with Old Mutual because I worked with them for 14 years. It's based out of the Isle of Man. It's a vehicle in which I can save on a regular basis. I call it a dumping ground for any surplus cash I might have. But it's not money that I'm going to need tomorrow or even next year. It's money that I'm saving for the longer term. We don't have retirement planning specifically here, so I need something that I mentally earmark for my future retirement purposes.
A bit more proactive, perhaps.
Being very proactive, saving for the future. This is my long-term dumping ground for my surplus liquidity, that when I move back to the UK, which I'm likely to do to retire in the future, I've got that wonderfully tax-efficient vehicle I can draw an income down from, I can grow tax-efficiently. And maybe ultimately, when I'm looking to succession plan and pass some of this wealth to my kids, I can use some trust planning. These things are really easy to hold inside an inheritance tax-efficient trust. So that's the type of vehicle we tend to use out here.
Brilliant. And just on that topic, Rebecca, I know allowances are a really key part of that. Do you just want to go into that for a moment?
Yeah, I think an important part for me when I'm talking to clients about returning to the UK and how to structure their investments and their assets in the most tax efficient way is to make sure that you're making use of the allowances that you're given. So everyone has a personal allowance that's living in the UK, so that's just over £12,500 a year. If you have rental income, if you have your state pension, another pension, or perhaps you still have some earnings when you're in retirement, you might have already used your personal allowance. But for a lot of people, and particularly in those years from when you've retired up until the point your state pension kicks in, that allowance can be wasted. So it's important that you structure your assets in a way that allow you to make use of that allowance. There's also an allowance for capital gains tax. So that's £6,000 a year, and the current tax year will be reducing to £3,000 from the next tax year. So as well as having the type of investment that Darren just mentioned, it's good to have some assets, could be some funds, some ETFs, some shares that aren't wrapped into, for example, a pension or a portfolio bond or an ISA, because if they just sit on their own, when you come to sell those, that would use up some of your capital gains tax allowance. So you can make sure your investments are set up like that. There's another small allowance for dividends, so you can have an asset that's not within a tax wrapper that produces a small amount of dividends to make use of that allowance, as it's only £1,000 a year. And then lastly, there's a couple of smaller allowances for bank interest and any savings interest that you get. So it's just important to make sure you've got something that will use up those allowances year by year to ensure that the way you've structured your assets to provide your retirement income is as tax efficient as it possibly can be.
Okay, brilliant. I think now we're sort of moving naturally in the direction of UK-based assets. So we've covered the kind of things that people should be thinking about when they're here in the Middle East. And of course, there's many different ways that you can approach this. And our team of financial advisors and the technical team are also here to help you kind of attack that and structure that in the best way for you and your personal circumstances. But Alex, on the topic of UK-based assets, you've got so much first-hand experience in working with people who've lived and worked in the UK, built up assets there, maybe pension assets, perhaps property. What are the first things that people should be thinking about when it comes to arriving in the Middle East, and what's the sort of housekeeping that people should be doing first and foremost?
Yeah, I mean, so the first thing I would say is this extends past, what some people would call one-time advice. The time that is associated with carrying out, the bringing up to date or getting information is extensive. For example, with HMRC, to be able to pay a reduced rate of national insurance contributions, that's a 6-month process. For understanding what sort of pension assets you still have in the UK, that again could be a 3-month process, because you're relying on pension trustees to release that information back to you. Those are some of the basic things that people should be reviewing when they get here. Like I said, once you've understood that information, you can then assess how those assets work for you now that you're in the Middle East, right? So the state pension, for example, is it going to pay you if you remain overseas? A question that someone asks me quite often. Your pensions...
And is it going to pay?
Yeah, well, yeah.
Brilliant.
But your workplace pension scheme, have you got beneficiaries set up on that in case something happens to you here? These are basic things that people need to understand before starting on the next step of the journey, which is the bridging the gap, as I've referred to.
And I suppose it's so easy to lose sight of all those things once you've left the UK, kind of out of sight, out of mind.
Well,
you haven't updated your address, perhaps. You haven't told your pension providers that you're now in the Middle East. And naturally, they're going to lose lose contact with you, haven't updated your mobile number, perhaps your new email. So those are some of the things that I would assume that you address first and foremost.
Yeah, I mean, pension companies notoriously only send one statement a year.
Mm-hmm.
I mean, don't get me wrong, a lot of it's moved online now, but as you said, if you move overseas, you're no longer at the address where that statement goes to. How are you supposed to stay up to date with that?
Becomes very difficult.
Well, exactly, yeah.
Yeah. And Rebecca, just to build on the point of pension assets and people working with them, we've seen a lot of increased consumer protection regulations coming out of the UK with regards to pensions, particularly where clients are based overseas. As someone who's qualified at the highest level in the UK, what advice would you give to British expats who need help with regards to their pensions, and what should they be looking out for?
So I think the key thing for me is to check that you're speaking to someone who knows what they're doing and has support around them to ensure that that advice is the right advice for you as the individual. So Darren and I are here, we work for De Vere, we can help clients. We have many pension cases that we do. We're involved in the cases, so the advisor is giving the majority of the advice, but they'll come to us for the kind of technical details and even just to hear it from another person as to, you know, the pros and cons of looking at that pension and moving it. And I think in the 5 years that I've been at De Vere, or 7 years in the Middle East, I have seen the regulation in this area increasing and improving, but typically that doesn't cover foreign assets. So we're talking about UK pensions or any other assets that you have overseas. The regulation here is more around the kind of investments that come within this country or across the Middle East. So we're lucky with the pensions that we move from the UK. If they're defined benefit or final salary pension, we have to take advice from somebody in the UK who is currently regulated through an entity in the UK. And that gives an extra layer of protection as such, because there is somebody who is reviewing that pension and pointing out the pros and cons of moving it. So that has strengthened the kind of process and the regulation. And there was also some new regulations introduced towards the end of 2021, which is essentially a way that the pension trustees in the UK have to assess each transfer with the view of identifying whether the advice or the reasons for moving that pension and where it's going are suitable. So they're looking out for unregulated people involved in the pensions, things like that. And there is a flag system. So if it was raised as a red flag, the transfer won't happen. There's amber flags where there's things that need to be done to try and rectify it, or additional warnings pointed out to the client. So I think that's a good thing that's been introduced as part of the process to ensure that clients are receiving good quality advice and that people are kind of acting ethically within this area.
Good. I mean, that's obviously the main and most important thing, is making sure that clients have protection in place. Darren, just building on the consumer protection side of things, and from De Vere Group's standpoint, we wholeheartedly welcome any regulation that stands to protect clients, especially those overseas. What were some of the reasons why this regulation has come in at such a speed, and what were the things that were perhaps happening in the past that sparked the need for it?
Sure. Okay. So I think this probably, Ciaran, goes back to 2004. There was some legislation in the Finance Act of 2004 which allowed UK pension members, particularly those in defined benefit schemes as well as defined contribution schemes, to transfer their pensions into an overseas environment. Many people listening today will remember the acronym QROPS, Qualifying Recognised Overseas Pension Schemes. Less used here in the Middle East right now for various reasons. They've been tightened up in that you can't transfer them quite so freely. But people were transferring their pensions from these gilt-edged defined benefit schemes with an employer guaranteeing to pay an income for life into the vagaries of the investment world, where you're investing in a portfolio that could go down as well as obviously up. And the people that were advising these clients were not necessarily regulated in the jurisdiction where they were based, let alone from the UK. It's impossible for the UK Financial Conduct Authority to regulate an advisor in a foreign country effectively. So what the FCA have largely done now is they've taken a stance that they do regulate the UK pension trustees, so people that are investing in UK registered pension schemes, and I include in that self-invested personal pensions. People refer to SIPs in this part of the world. They're still a UK-based scheme with a UK-based trustee, and therefore the trustees are regulated by the FCA, which gives consumer protection to a very large degree. And because they're now on the hook for the advice to some extent, the FCA can't regulate the advisor, but they can regulate the trustee. It allows them to now insist, the trustees will insist, that the advisor is appropriately qualified. So Alex mentioned before he was a UK qualified financial advisor. Rebecca and I have both worked in the UK. I probably most recently, from all three of us, have been regulated and actually been a UK-based financial advisor in the not too distant past. But that's what is required now for trustees to allow an internationally based advisor to actually place a piece of business with that trustee. And that's probably only in the last 2 to 3 years that sort of really happened. And I think now the portfolios that were way too high risk in the past, maybe advisors that were less well qualified, probably with best intentions at heart, but they didn't quite have that experience that they needed, were putting clients into too high risk a portfolio, and it was way too volatile. And the regulators have just tried to prevent that. So trustees now, just in very quick summary, will ensure that the advisors are suitably qualified and able to provide the advice, and that the portfolios are in a well-balanced, well-diversified, appropriate portfolio for your attitude to risk.
Okay, brilliant. I mean, this all sounds like good news for clients
Very much so.
who are based here in the Middle East.
Yep.
Alex, we've just touched upon some of the dangers that were perhaps more prevalent in the past. Could you just briefly mention some of the benefits of being an expat in the region with regards to UK-based assets?
Yeah,
Obviously,
I mean,
that's important to look at too.
Yeah, so I think everyone in everyone's head, the most basic reason why they come to the Middle East is they want a tax-free income, right? But I don't think everybody fully knows or understands how to utilize the DTA that is in place in it for this country, specifically the UAE.
Okay, so with DTA, this is your speciality, Beck, so perhaps we just switch over to you on this. Do you want to just talk through what exactly DTA means and how people can maximise the benefit from it?
Yeah, so DTA is a double taxation agreement, and it's essentially an agreement between two countries that specifies which country has the taxing rights. Things that will be covered within a DTA usually will be things like your pension income, rental income, your earned income. So, for example, if we look at the double tax agreement between the UK and the UAE, it will specify, well, this is the position if you're resident in the UAE, but, for example, you have a pension that comes from the UK. We're quite lucky in this part of the world for quite a few of the GCC countries in that for pensions, the taxing rights sit where you are resident.
Okay.
And as we're in tax-free jurisdictions, it works quite nicely because our clients, as long as they're over the age of 55, so that's currently the minimum pension age that you can access your UK pension, it is rising to 57 in a couple of years' time. But if you're 55 now, under the terms of the double tax agreement, if you're living, let's use the UAE as an example, you're living here, you can take money from your pension, whether that be a regular income or a lump sum, or you can now actually take the whole amount from your pension. Taxing rights sit in the UAE, so there wouldn't be any tax. And that is a huge benefit for our clients because if they're going back to the UK with a pension, usually you can have 25% of the value of that pension free of income tax, known as your pension commencement lump sum. In the UK, anything on top of that will be taxed as income, so in the same way that your salary would be taxed. But if you are to make use of the favourable terms of the double tax agreement while you're living in, let's say, the UAE or in Saudi or in Qatar, you can take all that money from the pension and then return to the UK with capital. So, for example, take the money when you're living in the UAE, you wouldn't pay any income tax on that. You can then return to the UK with your money that was in your pension, but now held in, for example, the portfolio bond, and you would then only be taxed on the profits, and you still get the other tax benefits that Darren had mentioned come with the portfolio bond. So it's a great opportunity.
Okay, so it does sound, to be honest, like a bit of an intricate process to get that all right. Are there some common misconceptions or mistakes that people make when they think they're doing the right thing? They think they're, mitigating tax as much as possible. But are there any pitfalls that people fall into when trying to do that perhaps without advice?
Yeah, there's a process to go through in order to get yourself in the position where you can extract your pension. But you have to be careful on a couple of points. So there's one around UK residency. So usually you need to have spent 5 years out of the UK to be able to access your pension in this way and it not to be taxed when you return to the UK.
Understood. Yeah.
I say 5 years, but it might not be as straightforward as 5 years depending on when you left the UK, if you've been back for any longer periods of time. So we need to check your UK residency, which is something that myself and Darren do on all of these cases. We also have to look at your pension and see what it offers, because it might be that pension doesn't actually offer the ability to cash it all in or take all the money out. So your pension needs to have something called flexi access drawdown, which the modern pensions do, but if your pension was funded 15 or 20 years ago, there was no such thing then as flexi access drawdown, so it probably will not offer it. And then the other big one is around inheritance tax. So when money is held in a UK registered pension scheme, it is free from inheritance tax. But if you go ahead and you want to take the income tax benefits by withdrawing the pension when you're living in the UAE, you're then putting that amount of capital into your estate.
Okay.
So it then takes away the inheritance tax advantage. But there are things that we can do to then put that back take it out of your estate with perhaps some trust planning, other things that we can do to allow you to get the income tax benefit and the inheritance tax benefits.
Okay, so there's a lot to go at there.
Yeah.
It's not a simple process at all, so people really do need to sit down and get proper regulated advice on this, as we've just spoken about. Just to close off the UK assets, specifically pensions part of the conversation before we move on to some more local information and news. Alex, I'm just going to ask, as someone who's had so much first-hand experience doing pension work with clients, talk me through the timeline, because I think a lot of people probably come to you thinking that it's a process that could perhaps happen overnight within a week. How long are we looking at?
Yeah, so I mean, just to really echo what I've already said, this is a long process, right? So if you want to access your pension tax-free here in the UAE, you're looking at about 6 to 9 months. To probably at a minimum to get that process completed.
And that depends on tax years too, as well, right?
Yeah. So, and then of course, again, you need to actually plan for that. The pension age, as Rebecca's just said, is rising. Are you potentially in danger of falling into a category where you might not be at the age to access it? It is not a snap your fingers, it'll be done tomorrow process. It requires some thinking and some planning.
Okay.
Once you've had all the advice from, or the guidance on the finer points from Rebecca and Darren, it needs to be the right decision.
And you need to seek that information from the providers. That's going to take time, as you already mentioned. With pension providers, sometimes that the information doesn't come super quickly once requested, and then the smile tells us everything that Alex has probably been through a fair few bouts trying to extract that information.
You know what, Ciaran? I think it's important to mention that the more time, the more notice clients can give us of their intention to repatriate, the better.
Sure.
A lot of the planning we can do quite quickly, but one very important thing in relation to extracting your UK pension is you can't do that in the same tax year that you return to the UK.
Okay.
So if you miss April and you take it out on the 6th, 7th of April, you've got to be back in the UK the following April and not before, or otherwise it just doesn't work. So the more time you can give us, the better.
And when you say doesn't work, what does that mean?
Well, okay, so you can extract the pension and have it paid out gross, but if you return to the UK within the same tax year that you extract value from your pension, and it's typically more than about £100,000 from your pension, then they will simply retrospectively tax that.
At your income
at your
rate?
normal, it's as if you were living in the UK when you withdrew that money from your pension,
Okay.
yes.
So let's say you're in a higher income tax bracket. That could realistically lose you 50%.
It could lose you 45% potentially
yeah.
of your pension, if you're not very, very careful. Yes. Yeah,
So it's worth sitting down and doing this very delicately.
To add a little tiny bit of detail to it, you cannot claim split tax year basis for pension income like you can with earned income.
Okay.
That's the reason behind the problem.
Okay, thanks guys for the information on the UK-based assets. Before we just move on to the next section of the conversation, we will say after the webinar today, we will be sending out some information via emails. If anyone watching today wants to have a chat with the team, they want to address any of the issues that have been covered thus far. Now, what we're going to do is move on to some more local news, because it's one of those where British expats need to be thinking about a lot of things. We need to be thinking about our UK-based assets. We need to be thinking about how we save here as well. So Darren, could you just tell us about the announcement that came out on the 4th of September and anything of note surrounding that topic, the British expats in the region? And this is more for UAE specifically, but what they should be aware of with regards to that news.
And it could spread into the wider GCC. So it may not just be UAE. Initially, it will be. Let's just moving the clock back a couple of years. We've been used to the normal gratuity system here, haven't we? The end of service gratuity. That's been in place now for a good number of years for the expat labour market. And then back in 2020, the DIFC introduced what they know as the DEWS system, DEWS, which is a compulsory essentially savings vehicle that employers have to contribute to for their employees. So anybody who's working out of the DIFC have been obliged to set up this scheme for their employees. And that's been mandatory. It's a savings vehicle. It acts a little bit like a pension, but it absolutely is not. As soon as you leave the employer in the DIFC, that lump sum is paid out to you, just like it would if it was a gratuity.
Sure.
But it's something that's been funded by the employer along the way. And that seems to be working really well. And what the Cabinet announced on in the early part of September was that they were going to expand this and put a scheme in place for the wider UAE. So not just for DIFC employees, but wider region, whereby it won't be mandatory for employers to set up these schemes, certainly not initially. So unlike the UK, where we have auto-enrollment and a compulsion on employers across the whole country for the vast majority of employees to fund a pension for them. Here, to start with, we're sort of dipping our toe in the water a little bit, and we're going to have this savings plan, which is just like the Juice system, probably. The details yet to come out in a huge amount of detail, but it will likely be very similar to Juice. So the employer will be able to fund it. The employee will have a choice, most likely, to be able to fund it or not. Employers can decide to put different schemes in place for different levels of employee and so on. And I think it just takes away some risk both for the employer and the employee. From an employer point of view, it means that they don't have to pay out a massive lump sum of gratuity, particularly.
This is similar in many respects to the DB schemes in the UK, right, where companies had huge liabilities based on the end of service benefit. Is it a similar kind of problem we're seeing?
I guess it is. It's probably more akin to defined contribution than defined benefit, probably, because these things are not going to provide.
But in terms of the departure of the gratuity system, where you had that large liability for the employers.
Yeah, sure. So that large liability will go away, but instead of paying out a lump sum straight from the balance sheet, they will have saved gradually into the savings
Which seems
plan.
a lot more pragmatic for employers.
Absolutely.
Yeah.
And an employee will be able to log on and be able to see this value increase gradually. They'll have a choice of investment from the suggestion is there'll be 3 different types: zero risk, presumably cash or government bonds, equity based where there's some risk, or Sharia compliant. And then there'll be various probable providers of these around the UAE. So really quite exciting. I guess that will at some point become compulsory. Maybe it will spread to the wider GCC. I think it's just the expat labour market maturing, as you'd expect, as time goes by.
Why do you think we're seeing that? And I'll open that to the floor. What's when you say the expat labour market maturing, what do you think's driven that?
I think it's just the general maturity of the market. You know, Dubai has grown over the last 20, 25 years. Well, just over 50 years in total, obviously. But, you know, the UAE generally has grown into what it is today, which is a very favourable tax environment, a lovely place to live, well-governed. You know, there's so many opportunities here. And a lot of expats, it's a desirable place to come and live, isn't it? But yet there's not perhaps the infrastructure in place financially in terms of particularly pensions, for example. We've seen the unemployment or the job loss insurance a couple of days ago was a deadline for registering for it. You know, that's another move in the right direction that we've not seen
I suppose
before.
that helps people stay, right? If you lose your job in the past, you were on a plane not too long after.
Absolutely.
But now you have a grace period, I guess, where you can find a new job, stay. And then from the government's perspective, they've worked so hard to build this incredible city and attract talent from around the world. It makes complete sense that you wouldn't want to just lose that on the basis of someone losing their job.
Sure.
Alex, I'll just switch over to you just for a second. On the topic of the legislation that's coming in with regards to these investment plans that are going to potentially become mandatory or compulsory in the future, what sort of investment options are available within these schemes? You've done some reading on this, I believe.
Yeah, so I think it's ultimately going to end up in the same direction as where DC schemes are in the UK, which is they will assess you based on your age, and then they will just automatically put you into a risk appetite and have an investment strategy based around that. So like cautious or defensive or moderate growth. But the problem with that is if you're not on it or if your employer isn't on the case, the default could be cautious, moderate growth, which is a combined portfolio that they have. You know, that might not be you. Given the current market situation now, you know, you might be a bit more cautious right now. You might not want to be taking on board too much risk. Likewise, you might be in the other direction. You might want to be taking on as much risk as possible.
So it gives you that flexibility.
It gives you the flexibility, but you have to manage it yourself, or your employer has to be on the ball. And that's again one of the issues that is sometimes associated with these kind of schemes.
Okay, brilliant. I think what we're going to do is wrap it up there. And finally, what I would just say is thanks so much to the team who've taken the time to join us today in the studio. It's been really great to get all the information out of you guys and share it with everyone watching from home. So thanks so much. And just as well, if you do want to reach out, everyone here is on LinkedIn. So the names of the speakers were in the poster beforehand. So thank you so much to everyone for joining us, and we look forward to seeing you again soon. Goodbye.
Thank you.
Thanks.
Thanks, Ciaran.